Hi, we are Pink and Queen. In our previous video, we talked about what's happening with the interest rates. Today, we are going to share why this might actually be beneficial for home buyers.
We need to first understand that the main reason of the Federal Reserve increasing the interest rates is to curb inflation. Let's go to the basics.
Interest rate is the cost of borrowing funds from a bank or financial institution. On the flip side, if you want to save more money, the interest rate will determine how much you can earn by leaving your money in the bank.
A rise in interest rates from central banks means commercial banks will earn more from reserves than from lending it out. If they do lend it out, they will raise their interest rates to make it worth their while. This explains why the Federal Reserve's interest rates are directly proportional to the commercial rates.
The biggest loan people will take from banks are home mortgage loans. With higher interest rates, it means that mortgages will become more expensive and people will have lesser cash to spend on other consumables.
Let's take for example, a home loan for $1 million property is $750,000. Now for illustration purpose, we'll assume that the interest rate is 2% and this amounts to a monthly installment of $2,772. Now if the interest rate increases to 3%, the monthly mortgage will now be $3,162. That is an increment of $390. This now means that the homeowner will have $390 less disposable income to spend. With households spending less, businesses will be warier of raising prices. Overall, it will make businesses reluctant to raise prices and that will tend to pull back inflation.
Now, if you understand these basics that we have just covered, it's not difficult to see that the impact of increasing interest rates will help to stabilize the overall prices of goods and services. We foresee that when it comes to the property market in Singapore, this might bring us in the right direction of stabilizing prices.
Here's how the increase in interest rate benefits home buyers. Let's say interest rates remain at the same rate of 2%, but that 1 million property has now increased to 1.15 million. The monthly installment would now be $3,188. That is $416 difference in the monthly mortgage. And on top of that, your deposit and stamp duties would also increase together with the purchase price. Don't you think it makes more sense to pay a higher interest rate than to purchase at a higher price?
In our humble opinion, if the increment in interest rates can stabilize the property market, buyers should take advantage of this window of opportunity to enter. We all know that interest rates fluctuate from time to time and can decrease after some time. It will not remain permanent and the monthly mortgage can be adjusted back down after refinancing.
Hence, there is nothing to be alarmed about the increasing interest rates. Also, we are fortunate that we can fall back on SORA being a backward-looking rate, which movements tend to experience a lag.
As always, we thank you for watching our videos and greatly appreciate all your support. Do remember to like and share our videos.